Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, October 13th, 2023. The big news this week was the Consumer Price Index report for September that was released yesterday, and here I have it up for you so you can take a look at it. Last month, headline CPI, which includes everything, rose by 0.4% and increased 3.7% over the past 12 months, while core CPI, which excludes food and energy, was up 0.3% in September and grew by 4.1% during the past year. Most of the numbers in that report came in as expected, so its impact on the financial markets was negligible. However, one data point that got some attention was the 2.5% decline in prices for used cars and trucks last month. Some economists view that metric as a harbinger of recessions, since it presumably reflects decreased spending power for middle-class consumers. And if you look at this grid here on the report, and you come down a little over halfway down, you'll see new vehicles and then used cars and trucks. And if you come out to the second last column for September 2020, you see minus 2.5. And by the way, if you go out to the far right column, they're down 8% over the past 12 months. Now, unlike new cars, of which approximately 85% are bought using some form of debt or financing, more than half of all used car purchases are made in cash. For that reason, the decline in used car sales is less attributable to higher loan rates than for new car sales. In fact, the price of new cars rose by 0.3% last month, even though car loans have become more expensive. And the St. Louis Fed tracks new car sales. Now, this chart here is over the past 5 years. You see the huge drop when the coronavirus pandemic hit, which closed a lot of vehicle showrooms. Then you see a big recovery over the next year or so. You see it peaking here in April of 2021. Remember, that was 1 month after the Fed started raising rates. Then a big drop as the Fed started raising rates. But since then, a steady increase. There's been a few drops along the way, but the overall trend is clearly upward over the past 2 years. Now, I've been thinking a lot about car sales lately. That's because they are big ticket items that can be deferred when consumers are feeling less confident about the economy. The fact of the matter is that total vehicle sales in the United States have been in an uptrend over the past 2 years, as shown in this chart, and increased last month despite higher loan rates. Now, I'm going to shrink this down to 1 year. And here you can see this last one is September, but again, also clearly in an uptrend. That is one reason why I added Lear Corp to the PF Growth portfolio in the new edition of Personal Finance that was published this morning. Now, Lear makes heating car systems and some other components that it sells to vehicle manufacturers. Its share price has dropped over the past 2 months, due in part to the ongoing labor dispute that has idled the manufacturing plants of some of its biggest customers, including Ford and General Motors and Stellantis, which is the holding company that owns Chrysler. But once the strikes are over, the entire sector should rally, and as should Lear. You may be thinking that now is not the best time to add to our growth portfolio, since most of the economic news lately has been ambiguous at best. But that is precisely why I think this is a good time to buy certain stocks. Once it becomes apparent to Wall Street that the worst is behind us, their prices could quickly escalate. That's this week's PF video update, and I look forward to talking to you again in another week. Thank you.